Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me remotely is Phil Mackintosh, who's the chief economist at Nasdaq, to review how policymakers and investors are modeling out the global impact of the coronavirus as we now start to focus on getting the economy turned back on. Phil, it's great to have you with me as always, and we're seeing the markets at the open hold the green for the time being as new cases continue to decline, as we can see on the first slide here.
Yeah, and that's despite a pretty rocky start to earnings season too. So obviously people are much more focused on the data for the COVID cases than they are on the company earnings, either that or companies are expected to have earnings like this. So it's interesting because in Europe, people are already starting to work on getting back to work with a sort of slow scale reopening of the economy. And last night in America, it seemed to be one of the topic du jour as well, is how much longer are we going to be on lockdown and how do we slowly open up the economy, or how quickly can we open up the economy?
Right, and that's the question that we're asking on the next slide here. How fast will the recovery be? V-shape, U-shape, L-shape? There's a number of conjecture out there.
Yeah, obviously from the survey that was done here, the U-shape was the most popular, but perhaps worrying is that the W-shape came second, because that talks about a second wave of cases. And there's a little bit of evidence to support that. Singapore has loosened up some of its lockdown and seen a jump in cases. And so that's a risk that we go back too early. There's still enough of us carrying COVID that we reinfect others. There's not enough testing. We don't know who we should be isolating. And we end up coming back to where we are right now again for another 2 months of isolation.
Yeah, and as we see on the third slide here, as we're with earnings, you have JP Morgan come out, and of course everyone listens to Jamie Dimon and his thoughts around the economy. But as you point out in your note, this is where the rubber meets the road, and where we're going to start to see data that reflects how it's going to impact growth, earnings, and of course, any kind of guidance going forward.
Yeah, and I think there's still talk that the bottom-up estimates, so the kind of fundamental valuations of companies, haven't really adjusted fast enough yet. And you can kind of see that from the first chart that just shows in the last month, even though the market sold off really aggressively, the actual earnings estimates of companies haven't changed that much. So what we'll do soon is get a whole lot of real data to see how much companies, at least in Q1, were affected by COVID. We'll get some forward-looking commentary, so ticker by ticker, we'll be able to assess the impact on its earnings in the next quarter or two and potentially going forward. And what that means for valuations is really important, because at the moment, the market sold off based on macro-style top-down valuations that expected the economy to slow down significantly and unemployment to spike significantly, which we've all seen. The rally that we've had now sort of speaks to the fact that maybe on a macro level, the slowdown won't be as significant as first feared. But what we don't know is just what's happened to earnings of companies. At the end of the day, the market is all about valuing companies. And if the earnings is different than what the analysts have got now, there could be some downside risk.
All right, as we look at our next slide here, really the big outlier, smaller companies, they must be a bigger risk because they don't have access to the kind of capital that larger public companies may have.
Yeah, and the small cap market has been sold off much more heavily than the large cap stocks. So this chart here just shows when there's a survey of the small businesses, it definitely seems like they might have less of a cash buffer to get through a shutdown like we're seeing. And that's a worry, because that could potentially trigger more of a credit crisis, where banks who have lent money to these companies, even maybe lent emergency loans to these companies, worry that they're on the hook for defaults. And that could trigger more of a credit crisis style, which is especially a risk if we go back into a W-shaped recovery, where we're back under lockdown again for 2 more months, and we're talking about 2021 before we know it.
All right, and let's wrap up with our last slide here. Governments and debt and financing costs. I mean, the trillions of dollars that are going into at least the U.S. packages are a significant percentage of our GDP. How are we going to pay for all this?
That's a great question, and it's trillions of dollars globally. The U.S. rescue package adds to around about 10% of our GDP. But if you think about it, we've been shut down for about 10% of the year. So it's probably in the right scale, although not all of us have stopped working completely. And that's another thing that we'll find with earnings is, we know that the hourly workers are down about 50%, but a lot of other people are still working. And some of us are actually probably busier than normal. Amazon is hiring, Walmart is hiring. The thing is, this is a lot of debt to be issuing. And so what are the ramifications as we come out? When we're talking about 2021, how will we pay this all back? It's not unprecedented, though, but it only has happened in the past in a war. So we've seen it before, but it's been recoverable, I guess, is the good sign.
All right, Phil, thank you, as always, for joining us on Trade Talks.
You're welcome.
All right, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.